Hey everybody, so this is 𝐓𝐔𝐍𝐄 here. I wanted to reach out to you and talk to you a little bit about this uncertainty that we've seen in the markets. And I know it's been a little scary watching your portfolio go up, go down, go up, go down, and hearing all this news that's out there. First and foremost, I'm going to tell you when it comes to looking at your investments, just turn off the noise. It's the best thing in the world that you can do if you can't handle the emotional roller coaster. I'm telling you, it'll make your life so much better. Now, let's take everything into perspective. First and foremost, when you think about the stock market does not like uncertainty. And right now, we have a lot of uncertainty. I mean, if you think about it, we got interest rates going up. We have inflation through the roof. We have a pending war in Ukraine. You have, pending elections coming up. You have political capital being spent on different types of the spectrum, depending on where you're coming from. There's so many uncertain things going on right now that is definitely making this market be a lot more on the roller coaster ride than you expected. So I get it. But what I want you to realize is that you do not have to react to everything that you see in the market. Now, I thought I'd do a little short video for you, giving you some insights so you can have some food for thought to let you know why you shouldn't just rush out and start selling because you see the market going down. Now, let's talk about a couple of things. First and foremost, I want everybody to understand what a bear market is, right? And correction of a market is, right? In layman terms, we kind of look at when the market is correcting. You hear this said all the time. It's when the all-time high of the market has gone down between 10% to about 19.9%. That means from the high of the time, it's gone down from 10% to 19.9%. So that's kind of a significant pullback in the market, right? Now, we started hearing pullback when we see roughly around 20%. And we started hearing the word bear market when it's 20+%, right? So understand, we are definitely seeing some volatility in the market right now. Tech market is getting killed right now. We see this. But here's the thing that I want you to kind of keep in mind. If you don't have to sell, then you haven't really lost anything. It's only on paper at this point in time, right? Because until you sell, it is not a permanent loss. It's when you sell because you're panicking and having emotions play a significant role, that's when it becomes a permanent loss, right? On paper, you can see this market going down. But here's what we want you to understand. If you're one of our clients at 𝐓𝐔𝐍𝐄 Wealth Management, understand that we've already thought this process through. And for the majority of our clients, you have been put into what we like to call our foundation, right? And most of our clients are somewhere between 35% to about 55% in the foundation. And remember, the beauty of the foundation is that there's probably going to be anywhere between 5 to 10 years worth of income set aside in that foundation so that you can weather any storm. That's why we did this to begin with, right? Because when we see this volatility of the market and we see the stocks up and down and going through this, we don't want to be buying, we don't want to be selling when we're down here at this point. And we don't have to force to sell as long as we got enough income coming into our household, right? Because this is really what drives us while we're in retirement. As long as there's cash flow coming in, then we're not forced to sell in the down market. And this is what I want you to realize. If you plan properly, if you work with your financial advisor, you shouldn't have to rush out there and make significant changes. Now listen, I know emotionally it's definitely hard to watch, right? But here's some statistics that I want you to know about how long these kind of markets work and how long they usually last. So typically, like I said before, most of the bear markets are probably going to be around on average about 9.6 months or 289 days. That's usually the average time frame. But when you look at the bear market, the market that we just came out of, it usually lasts about 2.7 years on average. Now, we went from 2008 to 2020. We're almost a straight run all the way up. That was almost 12 years, right? So there's been long-term time frames for those bull markets to go through, and we can take advantage of that. Now, the thing that I love about this is some of the biggest gains was during a bear market. because people were buying when things were low, and when it took back off, guess what? You took advantage of the upswings in the market. So let's not get caught up in the emotional roller coaster and worrying about selling down here. If you're not forced to sell because you don't have enough income coming in and you properly prepared by having this foundation put together that we always talk about in our office, right? Then you don't have to worry about jumping ship too soon. Just sit back, relax, turn off the TV, reduce the noise coming in, and put your mind at rest and ride out the storm. This is why we structured our plans the way we have, so that you could ride and rest easily whenever these types of volatilities come up. Now, don't get me wrong. I am totally understanding that you guys are fearful and emotion is kind of playing their role, but that's why I keep saying turn off the noise. Okay, guys, hopefully this helps a little bit. If you have any questions, feel free to reach out to us at the office. You can reach us at our office at 310-645-0001 or go to our website, 𝐓𝐔wealthmanagement.com, and we'd love to answer any questions you might have when it comes to planning for this amazing ride that we're about to have. Take care.